I know right now you're studying for the RD exam, but picture yourself in a few years when you're the manager of a nutrition department. You're overseeing budgets, staffing, food costs, and trying to make the best decisions for your team and your patients. So how do you know if your program is financially healthy? Financial accounting is how we record, summarize, and report financial activity of an organization. It's our template, giving us a clearer picture of where we are and helping us to make better choices moving forward. Now, this is the Math Foundations unit, and as dietitians, we need to understand the basics. The RD exam expects you to be comfortable interpreting financial reports, especially in food service or clinical management roles. You don't need to become a CPA or even know what a CPA does, but you do need to know how to read and use a few key tools. We'll walk through the essential equations together in this module and then return to budgeting in more depth later in Module 9. So when it comes to financial accounting, there are two key tools we use: balance sheets and income statements. Balance sheets give us a snapshot. They are a static evaluation of financial position at a single point in time. Income statements are also called profit and loss statements. They are dynamic evaluations that tell us a story over time. They're the dynamic evaluations of the revenue and expenses. Both are essential in financial accounting, and we'll look at them both. Starting with the balance sheet. The balance sheet is a still photograph. It tells us what an organization owns and owes at a specific moment. And it has three key parts. First, assets. These are the things that the organization owns, like cash, equipment, or inventory. Next are liabilities. These are debts and obligations, what the organization owes to others, like loans or unpaid bills. And then finally, equity. Equity is also known as capital, and that is what's left over after subtracting the liabilities from the assets. It's the net value or ownership stake, and they are related in this equation right here. The assets are equal to the liabilities plus the equity. And as I just said, equity is equal to the assets subtracted the liabilities. This equation must always balance. If assets go up, either liability or equity has to change with it. This is the core idea of a balance sheet and a good way to test your financial understanding. In contrast, an income statement is dynamic. It tracks what happens over a period of time, usually a quarter or a year. And like a balance statement, it has three components. Revenue is the income that the business brings in through services, sales, or billing. Expenses are the cost to run the operation. So that could be salaries, supplies, rent, or utilities. And then the net income is what's left over, the profit, the loss, or the break-even point. And it's all related by this key equation right here. Net income is equal to the revenue minus the expenses, or the expenses subtracted from the revenue. This net income is also called profit or loss, and it tells us, are we making money? Are we losing money? Are we running efficiently, or are we overspending? Both of these equations are relatively simple and straightforward, but you should expect them on the RD exam, and if you go into management, you will see them all the time in your professional practice. Let's put them to work. In this first problem, we're told that a dietetics practice has $50,000 in assets, it has $20,000 in liabilities, and it asks for us to solve for equity. To solve for equity, we'll use the equation assets are equal to liabilities plus equity. And then we can just plug in what we already know. We have $50,000 in assets, we have $20,000 in liabilities, and we're solving for equity, which I'm going to call X. So 50,000 equals 20,000 plus X. We have a pretty straightforward algebra foundations question here. To solve for X, we need to move this $20,000 to the other side. It's a positive $20,000. We have positive $20,000 in liabilities, so we have to subtract $20,000 from both sides of this equation. And when we do that, we'll be left with X on its own. We get $30,000 is equal to X, and X was equity here. Hopefully this feels like a straightforward algebra problem, and it reviews the basics of undoing the operation. Let's do a similar one, but now for income statement. This dietetics practice earns $80,000 in revenue. It's got $45,000 in expenses, and this one is asking for the net income. Well, you'll start to learn that net income is the revenue, this total intake, subtracting the expenses. And we know these things. Our revenue is $80,000 here, and we have $45,000 in expenses. So if we subtract these two things, we find out that we have a net income equal to $35,000. If you're thinking these equations are too easy, don't worry. We'll be doing more complex financial accounting in the upcoming videos. But try to keep these core concepts in mind as we build on them.